Hello and welcome. I'm Mike King, and this is an Air Cargo Unpacked interview, a Freight Buyers Club production. Each month, I sit down with Neil Wilson, editor of TAC Index, the leading global price reporting agency on air freight rates and the calculating agent for the Baltic Air Freight Indices, to look at where air cargo rates are moving and what's driving them. Now, we've seen multiple reports that air cargo volumes from Asia have dropped into Europe since Europe made major changes to its de minimis rules on July the 1st this year. So I started by asking Neil if we've seen this decline in volume showing up clearly on European inbound lanes.
Hello, Mike, and great to be back on the podcast again. So, to look at this China ex-China key lanes comparison, we look at China US versus China Europe, and if we look at China US, you can see that the market is off from its highs, but is still pretty strong, and it's up say 1.1% in the latest week we have before the recording here. And it's up some 30% year on year, which is bigger than the global averages, which we'll get onto on the next point. If you compare that to China Europe, you can see that's dropped off much more since this end of the de minimis regime at the beginning of July, and it's only up 12% year on year. So obviously the market has changed since the end of that. There's less volume, which I think you've probably had other contributors to the podcast noting, with some of that shifting onto Transpac out of China or other lanes out of Asia, such as ex-Korea. So clearly, although the volumes dropped, the rates have dropped even more, China, Europe. Now, having said all that, there are some signs, and we hear this anecdotally, that the market is starting to adjust to the new flat rate customs duty regime, and that rates are beginning to stabilize and then firm up in the last week or two. Like on the latest week we have on the chart there, you'll see that it's up very slightly, 0.3% week on week. It seems to have stopped dropping. The market is beginning to adjust, I think, is what we're seeing.
And that global market, Neil, how's that reflected there?
So to turn to the global picture, which we tend to do every month, we look at the BAI 00 chart, which is our global index, all outbound lanes. And you can see that unlike July, when that was falling, we had a interesting conversation about that last month because it was falling 5 weeks in a row while the jet fuel price was going up 4 weeks in a row. And that seems a very strange circumstance. In August, it's been sort of more flat to slightly up, less dramatic movement. But it's still up some 19% plus year on year to the latest week. So rates are still elevated. And yeah, it's been I suppose, a quiet month. We often see that in the summer season because you get demand easing a little bit, people going on holiday, and capacity increasing a little bit with the more passenger belly hold with people going on holiday. So those things have been going on. But in the background, of course, we've got these tensions still going on in the Middle East. You've got continuing problems with ocean shipping and blockages in the Strait of Hormuz, which you're probably covering quite a lot in your ocean shipping podcast. So rates have been flattish in the last month, but elevated still from where they were.
As you mentioned, no end to those problems in the Middle East, and we saw Brent crude hit over $100 towards the end of July. It then dipped again, but it's back up around about 90 US as we are speaking at the end of the third week of August. How's that impacting air cargo rates?
So yeah, this is interesting, isn't it? We talked about this last month that jet fuel is not the only input into the costs of running air cargo. It's about a third on average, given the cost of the equipment and the personnel and the other things you have to pay for. But it is a very, very key important input, clearly. And so when rates are going up last month, that's adding to the pressure. And if you look at the latest IATA jet fuel price monitor, which I think takes its numbers from the Platts data, you'll see that rates were easing into early August, the first week or so, but have been going up again through the middle of the month, an increase of 8% plus in the week to August 14th, and still up 76% year on year. So that's an awful lot more than the air freight rates have been. So the question is, if jet fuel continues to be that expensive and difficult to get, perhaps going forward, then surely that's got to have some impact on rates going forward too. It depends very much what happens with the US-Iran situation and the Straits.
What other major movements are we seeing, Neil, in other outbound markets?
So we've ones that we've touched on in previous months when we've done the podcast. Southeast Asia rates have been softening or so in the last week or two, but still well up year on year. There's a kind of summer low season effect in August there a bit perhaps. North Asia, by contrast, rates are still firmer. I think we touched on this last month out of Seoul and Taiwan. There's still strong demand for semiconductors and other AI related kit. And that's despite those stocks dropping a bit in the last month or so. And I think looking forward, we've touched on this maybe later in the year, the sources are saying that the demand from the hyperscalers in this sector could be key to the strength of peak season. If that continues to accelerate, then there's going to be more capacity moved to there, and maybe there might be a bigger peak season or not, depending on what happens. That's a swing factor. E-commerce is about the same, but the AI sector is a big swing factor. So just for this month, I thought we'd look at a couple of things we haven't done for quite a few months or for most of the year. And one is the Europe-US market, the transatlantic, which is obviously a big sector. And you can see that has a lot from the chart. It has a lot of seasonality typically. Peak season is quite pronounced. And it's still pretty strong year on year. It's up 17%, but has been easing off as that summer season has been continuing, down 5% in the latest week on the chart there. Reflecting, I think, perhaps belly hold capacity on the transatlantic routes being expanded this part of the year, and demand softening a little bit. Another one that we haven't looked at that I thought we might touch on this month is the US outbound Chicago BAI 50, which is typically a very volatile. The rates go up and down very sharply week to week there. But you can see that looks very strong year on year, up 53% plus 3% in the latest week. But I think one of the things to note there is that that's contrasting with very weak levels a year ago when there was a lot of things going on with standoffs on tariffs and trade issues and so forth, and the volumes dropped a lot. So it looks very strong, but it's versus a very weak point last year. So it's not really out of line with the global market.
That was Neil Wilson, editor of TAC Index. Many thanks to Neil for his time and excellent analysis. And thanks as always to TAC and the Baltic Exchange for their continued support of Air Cargo Unpacked. For more from the Freight Buyers Club, please subscribe wherever you get your podcasts and follow us on LinkedIn and YouTube. I'm Mike King. See you next time.